Welcome to your commercial-free, uninterrupted investment show, sponsored by the SEC-registered investment firm, Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who has been putting clients' investment needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, good morning and welcome to the Smart Investing Show. I'm Brent Wilsey, 8:01 on Saturday morning. Great to have you here this Saturday morning and every Saturday morning talking about your money, your investments, the economy, how to grow your net worth, and all these important things to grow your net worth. And with me, as always, almost always, is Chase. Good morning, Chase. How you doing?
Good morning. Doing well.
The weeks just tick on by here. I can't believe, is it next weekend is Halloween? No. Is it?
Yeah.
Wow.
It's crazy.
I mean, the holidays are virtually here. So, and I bring that up because we do have a report this morning on the National Retail Federation, the spending and so forth. A lot of great things to talk about. By the way, if you want to join the show, we usually kind of do a catch-up of what happened the past week, kind of bring you up to speed on what's going on. Phone numbers here, 866-577-2473. That's 866-577-2473. And as always, that'll get you through for your unbiased, no strings attached, fundamental opinion about what you want to talk about. But let's talk about the National Retail Federation is predicting a new all-time record for Halloween spending, which will reach, $10.1 billion this year. The previous record was $9.1 billion, and that was 4 years ago, back in 2017.
Wow, I mean, that's crazy to see that amount of spending, and not surprising with all the money out there in the economy, but there could be a problem. I mean, as you guessed it, shortages are already appearing at many of your main retailers. I'm sure in those container ships that are stuck off the coast, there are plenty of scary decorations and the ideal costume to impress all your friends. And I mean, gosh, we had clients in the office yesterday, and I had a nice meeting with them, and we're talking. I was like, the pictures are just astonishing.
Yeah,
when you look at those massive ships that are just right off the coast of Los Angeles and Long Beach, it just blows me away. And I mean, this problem is not going to be fixed anytime soon.
No.
I mean, this is going to go into next year. There's no way, even if you were able to unload all the stuff, you still have the trucking shortages and the labor shortages. And just to get all that stuff out of the ports and out of the warehouses, it's going to take a lot of time. But I mean, just to see that spending level, I mean, that's amazing.
Right. And actually, I've heard the numbers now, 100 ships. I don't know if that's a true number or not, but that's what I've heard. It's now approached 100 or 70. Now
it was like 57, and there's 57 off the shore and then 100 in the port.
And it could be the L.A. ports and the Long Beach ports together, because those two together. And then I've heard this past week, I also heard, and this is terrible, part of the problem is we've talked about the truckers and how they don't have it, truck drivers, but also, too, in the state of California, I found out this past week, that if your truck is more than 11 years old, sorry, you can't drive it in California. Well, I remember when I was on the surf and stuff, we had trucks that were like 30, 40 years old. You can keep a vehicle going for many years, and just because it's 11 years old, well, that's not very old if you take care of your vehicle.
It's really not. I mean, it's crazy, just kind of some of the regulations that you look at it and it's like, well, it's no wonder we're having problems.
Yeah, they're self-inflicted problems. So we will get through them, but it's just a shame. And again, you might have to go take a little rowboat, go out to one of these big container ships and get your costume, because that's where they could be sitting. So we will see. But I think, again, the prediction is $10.1 billion. That may be missed because they just can't get them out.
Yeah, I mean, I think that does lead into, we've talked about the holiday season. I'm sure we'll get some more numbers on holiday spending here shortly, but I do anticipate having a great holiday season. I mean, you see the numbers on Halloween. I anticipate strong items with Thanksgiving, especially last year we weren't supposed to gather for Thanksgiving. I think a lot of people are going to get back together, and I think same with Christmas.
Yeah. Could be a short of turkeys, too.
Yeah.
We'll see more about that as we get closer to Thanksgiving, but that's going to be a shame as well. And also, too, a lot of electronics come Christmas, they may not be there, so it could be a difference of what the people will be spending. We'll keep people posted on that. Yep. Let's talk about Tesla. Unfortunately, Brendan's not here because he loves Tesla, but Tesla continues to improve on revenue and earnings. Record revenue was reported at $13.8 billion, which delivered a $1.6 billion third quarter profit for the company. At this time, I have not been able to see how much of the profit has come from tax credits, but we'll keep people posted on that.
Yeah, so we'll be interested to see that. Still, we'll give the company credit for having a delivery increase of 73% more vehicles over last year. I mean, I still caution investors, don't think we've flipped the boat and now are big Tesla bulls here by any means, because the company continues to trade at lofty valuations. I would not recommend an investment in this company or any company that is so expensive like Tesla. And I just see it hit an all-time high. And we've talked about items like this before, but how in the world can Tesla now trade at over $900 billion in terms of market cap? It's approaching $1 trillion.
Yeah.
And GM is still under $100 billion.
$100 billion? I don't think that's small.
That's under $100 billion.
Are you serious? Wow.
Yeah, I'll pull it up right now. I believe when I looked at it the other day, it was $86 billion was GM's market cap.
And, Jason, when I was younger, I remember we had this Uncle Carl who was the rich guy from California. And all of a sudden, he came back disconnected. And I go, well, what happened? Carl lost all his money in the stock market. Well, this is how you lose your money in the stock market. I'm not saying that Tesla's going to go broke. I mean, Tesla has some fine cars. It's a great company. But this is how the Uncle Carls of the world, they pay these lofty valuations for these companies, and all of a sudden it just disappears. It happened in the 70s, the 80s, the 90s, the tech boom and bust. It's going to happen again. And this is why when you invest, and this is why, people say, oh, you didn't buy Tesla. It's like, no, I didn't buy Tesla. I'll never buy a Tesla. I'll never buy that type of company. I will buy your companies that I know will weather the storm, make 8, 10, maybe 12% on average per year. Your food companies, your financial companies, good solid businesses, because I've seen too many people that have lost their money and big amounts of money by investing in the high valuation companies, and it happens over and over and over. And this time is no different. You're going to have the same thing happen with the high valuation companies.
I mean, it doesn't make sense. I mean, Tesla's going to be $1 trillion company. I hate when people, it's not a car company. It's a car company. Where do all their money and profits and sales? Cars. Yeah. Elon Musk does a great job with SpaceX. He does a great job with Tesla. And, as much as I question some of, his antics, he's done a great job. Yeah. And, I will admit I was wrong several years ago when we looked at saying Tesla's going to go bankrupt and all these issues.
We were wrong, but they did come very close to going bankrupt.
Oh, yes.
Yeah. So they made it through, and congratulations on that. But we were not wrong based on what the balance sheet looked like and so forth. They were going to go bankrupt. So.
Yeah, and I will say I just pulled this up because just makes me laugh. Kathy Wood, I was curious what her target sell price on Tesla is. Right now, she said in 5 years, her base price target is $3,000 a share.
That's like more than a 300% gain.
That means Tesla, I believe, would trade at over a $3 trillion market cap in 5 years.
Yeah, because it's close to $1 trillion.
Yeah.
So, yeah. And these are the type of crazy things. You have these same type of crazy people in the tech boom and bust. Oh, Cisco is going to be worth, trillions of dollars and so forth, and they're going to do it. This is where people get burned in the stock market by being part of the hype. And we do run a concentrated portfolio, so we cannot invest in these crazy companies. Now, if you want to go out and you bought, I don't know, 0.1% of your portfolio on it, congratulations, you've done well. But be very careful, because this is how the Uncle Carls of the world, wow, he's so rich, and all of a sudden he is not so rich, and I think he had to live with his sister because he lost everything. It's a terrible thing, and it's because you do the craziness. And we don't have anything to talk about Bitcoin today and the ETF, but we'll maybe talk about that more next week. But just craziness is where people lose their money. And what I don't like, Chase, is I don't like that people say, well, the stock market's risky. And we've said so many times, the stock market is not risky if you do the right things. But if you're out there paying these high prices, these high-value companies, it is risky.
Well, and the thing I look at as well is a lot of times the people that are investing into Tesla, they've seen all these people make 1,000% on their money. And they're like, oh, I wanted to get into that.
Yeah.
I don't believe that Tesla should go up 10%. But a 10% return, if they were up 10% next year, that'd be a pretty darn good return.
Yeah.
Wow, that's not bad. The problem is the people that invest in Tesla, 10% is nothing to them.
Yeah.
They'd be disappointed with that type of return and probably sell it next year.
Yeah,
oh, I only made 10%. This is terrible. And I don't know. I think it's attracting the wrong type of investor into it, and it's just hype investing. That's all it is.
Yeah.
I mean, as I said, it probably now again is worth, and I'm just throwing out numbers here. It could be worth again the top next 10 auto manufacturers combined.
Yeah.
And it just throws out the idea of competition. I saw an interesting discussion on it saying that, Tesla is not the next Amazon, it's the next AOL.
Oh, really?
Yeah.
Wow.
And they were saying that Amazon has really distinguished itself to really kind of have no competitors. I mean,
Right.
When you talk about buying something online, oh yeah, I'm going to go to Amazon. I mean, they've done a great job. And again, I'm not saying go invest in Amazon, but they said with AOL, there was just so much competition out there with the boom in the internet.
Okay.
And they're saying the same thing with electric cars. It's not like Tesla is the only electric car maker. And I just don't see with, the Hummer EV coming out next year. Right. Tesla doesn't have, and I believe Mary Barra actually challenged Tesla saying, we have 25 EV models coming out by 2025. Tesla has the Cybertruck.
Well,
the
Cybertruck has been delayed as well.
I know.
Yeah.
But by 2025, I don't think they have anything that's new coming out where GM has 25 new models coming out by then.
And also, too, I mean, Tesla has done a great job of turning things around, opening factories, doing all these great things. But it's not worth, I don't know what trades at, 200 times earnings. It's not worth that because, again, they're not the only model that is out there. And you've got Porsche just came out with their car that just, and they said we're far better than Tesla. Now you do pay more for the new Porsche. I think it's called the Cayenne, I think is what they call it.
Yeah.
But it's far better than a Tesla car. And it's got the Porsche name behind it. So competition's coming. And what did Warren Buffett always say? He doesn't like competition because what that does is bring down prices, causes problems. So,
well, you look at a company like Lucid Motors as well. That's a new one that is also quite attractive to a lot of people. And it cracks me up here. Oh, well, Tesla's doing great in China. China does not want Tesla to be the premier auto manufacturer in China. They want NIO, or they want, I'm blanking on the other one, but they have their own that they would rather see win than Tesla.
Yeah, and I would not be betting my money on China. There's so many things with China that are going on. Last week I had lunch with Mike Pompeo, the Secretary of State under Trump, and he was talking about one of his big concerns is China and how things are not going the direction that we want to. We need to stop it now. And China does not. You're right. They don't want Tesla there. I mean, they want them there, but they want them there to maybe, I'll say, steal their technology. Maybe. Yeah. So.
Maybe. And I will say real quick is, hey, Tesla looks like a great value here.
What?
It was trading at remember it was trading at 1,800 earnings?
Yeah.
Now it's only trading at 300 times earnings.
Oh.
Wow. That's crazy.
That's better.
Based off history, I mean, gosh, this thing could go up 6 times,
Yeah. But we do have to check to see how much of that profit is coming from tax credits and not from actually manufacturing.
And on a forward basis, it looks like it's trading at about 150 times forward earnings.
Value company.
That's crazy.
Just kidding, folks. Please don't go out and buy it based on the value.
Yeah.
All right. We got one more thing to talk about. Do you want to get the phone numbers one more time? 866-577-2473. That's 866-577-2473. I do see coming up first will be Mike. But I do want to talk about, before we go to Mike, is Amazon announces they'll be hiring 150,000 workers on a temporary basis for the holiday season. The starting wage at Amazon is $18 an hour, and they said that these employees will be eligible for a sign-on bonus and hourly bonuses as well. There doesn't seem to be enough workers, as it will add to the equation that Walmart and all these others are adding workers as well.
Yeah, I mean, you look at Walmart in particular, they're looking at adding 150,000 people, Target 100,000 people. Then also, too, Federal Express and UPS are looking at 200,000 workers for the holiday season as well. Just in these few companies, now you're talking about 600,000 workers. Now, the problem is, where will they come from, and what type of bonuses and pay will companies have to come up with to get people to work? I mean, these costs will probably be passed along in higher prices to the consumer, more signs of future inflation, that's for sure.
Yeah, and also, too, I mean, and I did see this past week a restaurant in, I believe, New York City, high-end restaurant, obviously, but they are paying their servers $2,000 a week to be there. And I don't think they're going to get tips. I don't think so, but if they do, that'd be even more. But this is what's happening. To get workers, you have to pay them a large amount. But also, too, with Amazon and Target, it's not just going to be the workers, it's getting the products to sell. So, I mean, very tough time to be a retailer right now.
Yeah, I mean, it's not easy. And I do have a post that I wrote this past week, and we will be posting it next week. So I think we should talk about it here.
A little tease here.
Yeah, a little tease. But looking at these different industries that are kind of struggling, like the hotels and the restaurants and bars, is where does their employment stand now, and how much more are they paying their workers versus before the pandemic? And it's been an increase. I don't have the numbers with me. That's why I got to tease with it. So I think we should talk about that next week, because there's some interesting numbers there.
Yeah, it'll be a scary show next week.
Yeah. We'll see, Halloween.
And actually, next week we do have Dan McAllister, the tax collector for San Diego, talking about property taxes coming up. So I'm excited to have him on to talk about that. So, all right, phone number is 866-577-2473. Let's go out to San Diego and speak with Mike. Mike, you're in the Smart Invest Show, Brent Chase. How can we help you?
Hey, good morning there, gentlemen. Great to talk to you guys today. Actually, my stock for today, Winnebago Industries, WGO.
Do you hold that or looking at buying it?
I do not. Actually, I was looking at different earnings reports over the last week and saw the Winnebago had popped up and kind of intrigued me. I don't normally look at small cap companies, and but in comparison, I thought it looked pretty interesting. Wanted to get your take on it.
Yeah, I know they did very well over the past year because they went down like many companies did because of COVID. But they really exploded after that as people wanted to travel, and this was a way to do it. So I'm glad you called about Winnebago, because I do want to check into it and see what it looks like. Their symbol is WGO. Percentage short is a little bit higher than I would expect. It's 12.9%. Institutional ownership is 92%. The PE ratio does look good, though, 8.1 versus 13.1. Price to sales 0.6 versus 1. Price to book value 2.1 versus 4.7, and price to tangible book value is 7.1. The industry is 100 plus, so it's pretty expensive for the industry, but not for Winnebago. Price to cash flow 9.7 versus 10.2, and they have a nice PEG ratio here of 0.5. That is half the industry at 1. Now, looking at the growth, what they have done, wow, their 1 year earnings change, earnings per share is 285%, but the whole industry did do well, growing 265%. But the 5-year average does favor Winnebago at 33.4 versus 17.1. The sales growth over the last year is 41.4% versus 21.3. Sales over the last 5 years is 27.8. The industry not quite as well at 4.8. And the 5-year estimated share growth estimate is 15% for Winnebago. Looking at the industry to grow at 35% on their earnings, so a little bit better for the industry there. They do pay a dividend. 1.1% is what they pay. That's the same as the industry. They only use 6.6% of their earnings to pay that out, so that is not too bad there. It means they could, in my opinion, probably raise it. Actually, the 1 year change is up 50%. 5-year change is 12.5%. So they seem to grow that dividend. Probably a little change with COVID last year. Taking a look at the balance sheet, we got a current ratio of 2.6. That's very good. The industry is at 1.8. Debt to equity, 50% for Winnebago. The industry is at 100%. We do see that the inventory here, this is important. Days inventory is 44.2 versus 244, and days sales outstanding is 24.9 versus 45. So the inventory and the sales, Winnebago far better than the industry. We do see a net profit margin 7.2 versus 7.6. Return on equity is 23.8. I'm okay with that for Winnebago. The industry does show 48.9. Chase, what do you got going forward?
Yeah, so current price here for Winnebago, again, ticker symbol WGO, $67.30. Wow, 52-week high, $87.53. So definitely seen a pullback here. And that occurred in March, so it looks like it's been trading downward since earlier this year.
Probably energy.
Yeah, good point. 52-week low, though, on Winnebago, $44.33. That occurred last November. Year-to-date return, it's about up 13%. Not done as well as the market, but it's still up on the year. If I go out to August 2023, though, I see estimated earnings per share of $9.11 would give us a target sell price of $151.23. So that looks very attractive. It trades at 7.4 times future earnings. I mean, great valuation. But my problem here is, I mean, I look at going out future years, and we go from 10 analysts to 1. So you got to take that with a grain of salt. But I look at 2024, $7.97. 2025, $7.19. And I do wonder the same thing that this analyst is kind of looking at. They had this big boom.
Right.
What is now going to be the catalyst to have that boom continue? I don't think it's going to happen. I think we're going to see people go back to flying, go back to Hawaii, go back to their tropical vacations and not get in an RV and travel somewhere. I could be wrong on that, but that is my personal opinion here, that I just don't see what is going to be the item that continues to generate earnings growth for Winnebago.
And Mike, I forget when they had when prices on gas went up before. I think it was like 3-4 years ago, and the RVs got hammered because you look at, I mean, right now I got an Escalade. I go and I fill my car up now. It's about $80-$90. You got a Winnebago. I don't know how big a tank they have, but you're probably talking $500 to fill the tank. I mean, that's kind of a turnoff for people, and I think that higher energy costs really hurt your RVs. So even though we have high earnings estimates going forward, I don't know if that's baked into the equation yet.
Yeah, and I don't think energy prices are going lower. That's true. I mean, Joe Biden in his town hall the other day he didn't know.
I won't comment on that.
I know. Joe don't know. Yeah.
Joe don't know. Okay. But yeah, I would have to say, even though the numbers look good on the earnings going forward, Mike, I just don't feel comfortable with what energy prices can do. And I think you could see those earning estimates come down as energy stays at least at the current levels. I mean, here in California, the average cost for a gallon of gas is, $4.45, $4.50, whatever. So not good for the Winnebagos of the world.
Right. I typically don't look at these specialty companies that much. It just intrigued me, and I noticed a lot of friends and family had taken to the RV route. But when I was reading on some of the reports, actually one of the increases that I saw was the towables rather than the actual units, and that they had also acquired the Chris Craft into the water boats. So it's definitely a specialty recreational type, but I appreciate your insight there, and it'd probably still be on my watch list of things to kind of see how it goes. So
yeah, and I would think maybe not now, but maybe next year, and I don't think that's going to happen, but if you see energy prices stabilize or go down, the president does do something different where he does open the pipeline or something else, that could help these companies. But I really think that their big concern right now is the cost of energy. But watch that, and could be a better buy down the road. All righty?
All right. Well, you guys have a good weekend, and take care.
You too, Mike. Thanks for calling.
Bye.
Bye-bye. All right. That does open the phone line, 866-577-2473. That's 866-577-2473. Let's go to Oceanside and speak with another Mike. Mike, you're on the Smart Investor with Brent Chase. How can we help you?
How are you guys doing this morning? I would like to stay on topic. You guys talked about Tesla, and you mentioned some of the other electric vehicles. Curious about Ford. They got this Ford Lightning F-150 truck market is huge in the United States and other places. The thing is going to be able to power your home for 3 to 10 days in the case of an emergency. They're going to convert the Mustang, which has been, the trucks and the Mustangs have been their biggest seller. And, Ford seems like they were a company, World War II, they were able to gear up quickly, change their assembly lines. And being a U.S. company, you don't have the issues of shipping, which is an issue right now. And I think it's trading at $16, but, it was a lot better at 12. But just wanted to see, I know they're not paying a dividend anymore, but what your thoughts were on that and maybe some of the other top American companies that are positioned well.
Sure. I'm glad you called about Ford. I mean, I give Ford some credit here because they really turned things around on the EV side. I think it was like just 2-3 years ago, GM was way out in front. Ford didn't have much on the drawing board, so to speak, and now they've really come around. They've got some good things, so they are being a a good competitor. I do want to look at their numbers here too.
Yeah, I was gonna say I'm curious on Ford as well. I mean, GM talks a lot about different like kind of ancillary revenue streams and kind of more service-based revenue.
Yeah.
I'm curious what Ford has in that, because if you can get that reoccurring revenue, that's where Wall Street generally will kind of increase your multiple on what you're paying for the earnings, the sales, and so forth. So I that's one thing I would be curious on Ford is how can they kind of generate reoccurring revenue? Are they in that same boat as GM where they have those different business lines they're working on?
Yeah. So
Yeah, it's interesting you say that, because I also read that they're combining with Sunrun to do a project whereby they will build into your home the ability to be able to go from home to car to home. More of a power station type of an idea for your home, and I'm wondering if that's something that might be relative to in this environment.
And I do believe that GM is still the leader here, because they're doing so many. They have the Cruise, they have a lot more things on that. But I think Ford, you bring up some things that Ford is trying to they're not just sitting back saying, oh, we're just going to sell cars. They are doing other things as well. I do want to look at the numbers because I'm very curious, and I wish I could kind of compare to GM, but I don't have that capability right now. But let's look at some numbers at Ford right now. They are obviously in the auto manufacturers industry. Short, very small, 2.6%. Not worried about people shorting it. I am surprised institutional ownership is only 54.2. That's pretty low, I would think, for a car company, but that's what it is. Now, their PE ratio, not a great deal here, 19.1. That is the same as the industry. Price of sales is good, though, 0.5 versus 1.2. Price of tangible book value, 1.9 versus 4.5. That is good. Price of cash flow, 3.1 versus 8.5. And they got a nice PEG ratio here of 0.2. And I say that because the industry is at 2.8. Now, their earnings have not grown over the past year. Did they report earnings this past week, Chase? I don't think they did.
I don't believe they did.
Yeah,
no.
okay, yeah, because I thought maybe they just reported earnings, but no, they did not. So no earnings growth over the past year. Industry was at 65.4. The 5-year earnings per share growth for Ford is a decline of 14%. Industry up 1.4. Now, sales growth, again, nothing impressive here. 4.2% for Ford, 7.2 for the industry. 5-year sales growth for Ford, a negative 2.3. Industry was a negative 6.1. However, the 5-year estimated earnings per share growth is 72% for Ford, showing good things going forward versus 29.4 for the industry. And again, no dividend there. Looking at the balance sheet, we got a current ratio of 1.2 that is slightly under the industry at 1.7. Debt to equity 430% versus 80% for the industry. But again, there's probably a lot of accounts receivable or loans that they do the car loans in there, so you got to kind of dig deeper into that. Very important for these companies are days inventory, 42.5 versus 56. That's a positive for Ford. However, days sales outstanding is 115 versus 50, so they're having a little bit of trouble with their sales there. Could be because of the shortage of maybe not getting the vehicles. Net profit margin 2.5 for Ford, 6% for the industry. Return on equity is 9.9 versus 12.3. Chase, what do you got over there?
Yeah, so current price for Ford, $16.28. 52-week high, well, that's $16.70. That just occurred actually a few days ago on October 21st, so trading right near that level. 52-week low, though, for Ford, $7.61, occurred last October. Year-to-date return here, 85%. So, I mean, it's definitely had a phenomenal 2021. I'd say people are definitely giving it a lot more respect now. I think kind of with the Ford Lightning, I think that was a big thing, the F-150 Lightning, that really generated that catalyst to send them higher. But going forward for Ford, I see 2022 estimated earnings per share $1.85 would give us a target sell price here at $30.71. So, I mean, it looks very strong on those valuation levels. On a Ford PE basis, that's about 8.8. Now, you said you wish you could compare it to GM. I did pull up GM.
Good.
They're trading at 8.5 times future earnings. So now Ford is actually trading at a higher valuation than GM, which is honestly quite shocking to me. I think GM is a better company here. I think they deserve a higher multiple than Ford. But I think what's happened is you've gotten the momentum, and I think momentum investors kind of come into Ford. Oh, it's up 85%. I want to get into it. I think, honestly, GM's a better buy here just because
They
the
got
valuation.
More, the valuation,
And I think
also, too,
it's a better spot.
And they have, is it Bright Point or something?
Yeah.
General Motors has a lot of different things going on, and I love the CEO, Mary Barra. I mean, she has really done a great job. I don't know as much about Ford and their CEO. They have turned things around compared to being what I would call a dead company, but I just don't know how far they have come, which kind of concerns me on the valuations, as Chase said. So I'm not thrilled with it, Mike.
I mean, it looks okay.
Yeah, it's okay. Yeah. So.
All right, great. Thanks a lot.
All right, Mike, thanks for calling. Have a good one.
All right.
Bye-bye. All righty, that does open the phone line, 866-577-2473. That's 866-577-2473. Let's go out to San Diego and speak with Jim. Jim, you're on the Smart Investor on Brent and Chase. How can we help you?
Hi, Brendan Chase. Hey, I have a question about a stock, Silvergate Capital. It's kind of a local bank, but I believe they kind of process transactions for a lot of the crypto trades. And I know they're probably way overvalued, but I'm just curious as to what the numbers say their valuation should be.
And let me take a closer look. Oh, shoot, I did the same thing again. I said I was shoot, didn't I?
Yeah, you did.
Okay, good. Let's see. Silvergate Capital. Yeah, I mean, that because I'm getting something different here on the industry. I'm getting a utilities regulated water, and you said it's a bank. What are you getting, Chase?
Yeah.
Are you getting?
Mine's loading.
Yours is loading.
I
Yeah.
got the blue circle. Yeah, I got Banks Regional.
Yeah, I got utilities
Hit
regulated water.
refresh.
Let me hit refresh. See what happens. Okay. See if that comes up with the right thing. Yeah, because I kept hitting the same thing. There we go. Okay, that refresh button works pretty good sometimes, doesn't it? Okay. Silvergate Capital, symbol is SI. And Jim, you said you own this, or are you looking at buying it? I'm sorry.
No, I sold it last week, actually, at about 30% profit.
Okay. All right. Well, let's take a look to see what it looks like now. And I do have some concerns on the regional banks and how they're going to make money. So we'll talk more about that as we go along here. Short is about 9.9%, which is a little bit on the higher side. Institutional ownership, about 78.9. They do have a high PE ratio of 53.2 versus 14.4. Price to sales, 23.4 versus 2.5. Price to book value of 3.6 versus 1. And then price to tangible book value is 3.6 versus 4.1. No price to cash flow, no PEG ratio going forward. We do see their earnings per share growth for the 1 year has been 103%. That's above the industry at 60%. Nothing for the 5 years. I think it could be a newer company. Sales growth,
Yeah, it is.
It is, okay.
Yeah.
49.2 sales growth, well above the industry at 5.6. They do not pay a dividend. Let's take a look at the balance sheet here. No current ratio. They show no debt. Looking at the net profit margin, very attractive, 41.3 versus 21. Return on equity, not so good at 5.7 versus 10.2. That's about all I got, Chase. You got anything going forward here?
Yeah, so current price here for Silvergate, $145.92, 52-week high, $187.86. I mean, this is quite shocking because the 52-week high occurred on February 2017, and the year-to-date return is up 96%. So that means within the first 2 months, basically, it just popped.
Right.
I mean that's a huge return. But 52-week low, $19.15. So it's definitely appreciated quite nicely off that low. But going forward for Silvergate, I do see in 2022 the company's estimated to make $3.63 would give us a target sell price of $60.26. So I'd say your inclination was right there, Jim. It is quite pricey. It trades at over 40 times earnings, 40 times future earnings, I should say. I will point out, I mean, they are estimated to still see good growth on those earnings. 2023, we do drop from 8 analysts to 5, but it's estimated to go from $3.63 in earnings to $5.05, an estimated growth of about 39%. So, it's interesting to see a bank grow at these levels, but I think I'd rather watch from the sidelines. It's just too pricey for us.
And Jim, I think you mentioned something about cryptocurrency in there. What's the relationship there?
Yes. Well, it says, I'm just kind of reading off of Seeking Alpha here. It says Silvergate Capital has emerged as a leader in financial services for the crypto industry. It goes on, but somehow it's related to that. So it kind of benefits from the hype around the crypto stuff also.
Okay. Yeah, this bank could trade because I know crypto didn't reach a new high, this past week of, 67,000. I think it's pulled back somewhat. So it may trade almost as a cryptocurrency play. So it'll ride with cryptocurrency as opposed to a regional bank, which I'd rather be in a real bank, and not say they're not a real bank, but a bank that trades on something else besides banking industries.
A real bank.
Well, that's exactly right. That's exactly how it kind of it's riding the wave there, and yeah.
Yep. So in something like this, I would say stay away. I think you said you made like a 30% profit, so congratulations on that. But I
made a right. Yeah, that's what I figured.
Yeah. So good. I would not go back in though. You're welcome. Take care, Jim.
Thank you, guys. Bye-bye.
Bye-bye. Alrighty, that does open the phone line, 866-577-2473. That's 866-577-2473. And Chase, we do have, I know this coming week, we're going to make some comments on the new ETF for cryptocurrencies. Yep. And if people are not following us on social media, we're on LinkedIn, we're on Facebook, I think those are the two main ones. Oh, Instagram, that was the other one. But they can follow, our posts that we do, because we do cover some of the important ones here, but we do have other ones that we do go over, because we generally try to do a couple posts a day to try to keep people informed of what's going on. But that's one we'll probably talk about on the radio show next week. But if you do want to follow us, you can go to on Facebook. It's Smart Investing with Brent and Chase Wilsey. That's one thing to do. And then also, too, we do the YouTube every Friday.
Yeah, I was going to say, yesterday we actually talked about Federal Express, FedEx is what I like to call it. But, talk about the transportation problems, the labor shortages, and just moving all these goods that people are buying. Right. What's FedEx look like? Hey, go to our YouTube channel, and you just look in Smart Investing with Brent and Chase Wilsey on YouTube. You can find our weekly stock analysis is what we call it, our Smart Investing weekly stock analysis. And, I think we have some good episodes there, especially we take a kind of deeper dive into it on the radio show. I'd say we give a company about, 3 minutes on average, I would say. Yeah. Where on the stock analysis, we'll jump in there most of the time, 10 to 15 minutes, kind of a deeper dive, as I said.
Talk more about it. And I did make a comment yesterday, and sure enough, I got caught on it. This guy goes, I showed my age because I talked about the Kmart blue light special, and he goes, yeah, you showed your age. I go, yeah. So people that are probably close to my age will understand, like, oh, yeah, we remember the blue light special. Yeah. That's what we said about Federal Express. So if you know what that is, you might want to go check it out. Alrighty, let's go out to Prescott, Arizona, and speak with Rich. Rich, you're on the Smart Invest Show, Brent Chase. How can we help you?
Hi, Brent. I'd like to get some information on a company called Mosaic. MOS is the symbol.
Okay, and do you hold that or looking to buy that?
We're looking to buy that, my son and I.
Oh, okay. Okay, you have a joint account together? You're going to buy it one account?
Well, he's just going to get started with that. We might be opening a small brokerage account for him.
Cool. Very cool. All right, well let's take a look at Mosaic. Symbol is MOS. Let's see. Oh, I got the wrong place here. Let me go. Here we go. They're in the agricultural inputs industry. Very small short on this, so 1.6%, but 79.7% of the institutions own this one here. We do see, or actually institutional ownership, not 79.9 or 79.7% of the institutions own it, but the ownership is 79.7%. PE ratio 11.3 versus 29.7. Price to sales 1.6 versus 1.7. Price to book value checks in at 1.5 versus 1.9. Wow, price to tangible book value very good, 1.8 versus 30.8. Price to cash flow 8.4 versus 10.7, and a very nice PEG ratio 1.1 versus 11.9. We do see the growth on earnings over the last year, not material versus 198.6 for the industry. I would want to know what happened to their earnings over the past year. 5-year earnings growth does look good at 24.1 versus 18.2. Sales growth over the last year at 19.7% for Mosaic versus 11.2. 5-year sales growth for Mosaic is only 5.9, not nearly as good as the industry at 19.4. We do see a 5-year earnings per share growth estimate, 7% versus 7.3. They do pay a small dividend. It's a 0.7%. I do notice the industry is at 2.4%. They use about 6% of the earnings to pay that out. They could definitely increase that dividend to make it more attractive. We do see that they have on the balance sheet a current ratio 1.2 versus 1.7. It's lower, but I'm okay with that. Debt to equity 50% for Mosaic versus 0.6 or 60% for the industry. Looking at, let's see, day sales outstanding. I'll take a look at that one. 34.1. That's very good. The industry is 86.1. Net profit margin 14.3 versus 7.3. And then return on equity 13.7 for Mosaic, which is well above the industry at 6.2. So I like that. What do you got going forward?
Yeah, I did look at what this company does exactly. I mean, they produce and market concentrated phosphate and potash crop. I'm not sure what potash is. I'm not.
I've heard that name before. I think it has something to do with energy. I'm not sure.
I'm not quite sure, but it is nutrients in North America and internationally. Their main three segments are phosphates, potash, and fertilizants. So it owns and operates the mines, which produces the phosphate crops and nutrients. So basically, as you kind of said, it is an agriculture company. I generally like businesses like this. I mean, I don't know what potash is. I'd have to understand that a little bit more. But the concept is, agriculture, it's a basic business, and it's something that is needed in our society. So it's not like, oh, they're going to be replaced by technology or anything like that. So I think that is quite intriguing. Current price here for Mosaic, though, it is $42.01. 52-week high, $43.24, and 52-week low was $16.01. So wow, it's done quite well this year, up 83.7%. But going out to December 2022, I see estimated earnings per share of $4.96 would give us a target sell price of $82.34. So, I mean, it's still a great value as we look forward. I might be patient with it, though, Rich. It's gone up so much. I generally like to kind of wait, maybe try and get a little bit more of a pullback on it. I don't like to buy things when they're up, gosh, nearly 100%.
And also, too, look to see what potash, is that what it was?
Yeah.
see what potash is, because we're not really sure. Sounds like it's something important with the company. Unless you know. Do you know what that is, Rich?
Well, it's a fertilizer. It was real popular. The price skyrocketed back in, I think, around 2008 or something like that. It was it got a lot of press and everything, but I kind of tapered off since then, obviously. But I'm just thinking that I heard a little blurb done on Fox Business this last week, and they were interviewing a farmer, and he said that the price of his materials and things were going to be skyrocketing, boxes and fertilizers and things. So I started poking around and came across this company.
Yeah, I mean, I agree with Chase. I think I'd wait for a pullback. I hate to buy things as they've gone from the lowest $16 to $42. That just seems like, and it could go higher, but we like to kind of get things on sale, not buy them when everybody else is buying them. So I'd be patient, maybe watch it, and you could get something maybe next week, next month, maybe 3-6 months from now. But I'd say be patient as well. All righty?
All right. Sounds good. Thank you.
Okay, Rich, thanks for calling. Have a good one.
You as well. Take care. Bye.
Bye-bye. All righty. That does open the phone line, 866-577-2473. That's 866-577-2473. And I actually see we have all phone lines open, so if you call in, you'll be the first up right after we talk to our financial planner, Harrison Johnson. Good morning, Harrison. How are you doing this morning?
Good morning, guys. Doing well. How are you doing?
Good. I like this topic, RMD for spouses with an age gap. Now, we got to be careful here, but you go ahead and I'll tell you why you probably want to be careful here.
So the point I wanted to make here is if you are married and you and your spouse have an age gap of 10 or more years, that means your RMD schedule, required minimum distribution schedule, is on a completely different schedule. And actually it means that when you're taking RMDs, you are subject to a lower withdrawal rate. Now, the reason we have to bring this up and talk about it is most custodians, whether it's Charles Schwab, Vanguard, Fidelity, whoever, usually they don't catch this. So they'll just use the regular schedule for you and say, okay, you're 75 years old. This is your RMD. This is the amount that you have to take throughout the year. You take that and then pay taxes on it. But again, if your spouse is 10 or more years younger than you are, that means you legally have to take, or you're allowed to take, a smaller amount subject to a different schedule. The only way to qualify for this is your spouse has to be the 100% primary beneficiary on that pre-tax account. And if they are, then you're subject to a different schedule. And you have to let your custodian know about that so that you're not taking more than you have to.
And the reason why I say we have to be careful here is we're not advising people for guys to go out and find a younger wife so they get a better table on their RMD, because it is something that, again, 10 years is a difference. And you're right, a lot of people don't realize that. And I actually do know quite a few guys that their wife is 10 years or younger than them that are clients and so forth. So it is something that is a positive. But here's, again, another thing that you said that many times it's kind of brushed over, and unless you have a good financial planner that picks up on that and has a little detail, it's going to cost people more money taxes.
Yeah, exactly. And, with the RMDs, you can take as much as you want if you want to, but the RMD says you have to take this minimum amount. And so if you can reduce that minimum amount that you have to take, well, you can take more if you want, but if you're able to take less, that means a lower withdrawal. That means more money staying inside that account, continuing to grow tax deferred, lower taxes on that distribution. So to give you an idea, that second schedule with the 10 or more year age gap, it's dependent on your age and your spouse's age. So the table to figure this is massive because you have to line up your ages and everything. But just to give you an idea, if you're somebody who's 75 years old, that means your distribution from an IRA for your regular RMD would be about 4.4%. That's the amount you have to withdraw from the account, pay taxes on. If you're 75 but your spouse is 55, that means you have to withdraw about 3.2%. So it's not a huge difference, but depending on the size of your IRA, that could be several $1,000s that you don't have to take out, and you shouldn't be if you don't need it, and you shouldn't be paying taxes on that money. So it's definitely something that you want to be aware of.
And Harrison, one thing I noticed yesterday, because we call our clients, once a year, kind of check in and tell them what they've done and so forth. I talked to a client. She's been a client for, I think 33, 35 years now, and she's now 93. And I looked at her IRA. Her IRA is still growing because the distribution is still not taking more than what she's earning. And I was going to show it to you, and I didn't get a chance to walk across the hallway to you there. But, I mean, I'm just kind of curious when, and I think we use a annual recalculation maybe is what we're using on hers, but I'm just surprised because she's 93, and I don't know what her distribution amount is, but I look at it, the account's still growing even though she's taking out from it. So I'll have to show that to you on Monday. Maybe that's something else you can talk about next week.
And that's a very good point to bring up because, once you turn, right now the law says 72, that might get increased to 75. Once you turn that age, you have to start taking those RMDs. But every year that you get older, the percentage you have to withdraw from that account goes up a little bit. But as you said, Brent, many times that account grows faster than those distributions are, which means the dollar amount that you're withdrawing every year gets larger and larger, not only because of your age, but also because of the account growth in that. So it's not a fixed amount you have to take. It's a percentage of the account also based on your age. So that's really the best case scenario if you can continue to grow that account over time, have more of that tax deferred growth, but it is going to mean more and more taxes as you get older. And eventually, as far as the distribution goes, once you get really old, I think the amount that you have to take is like half of the account, and that comes out at like age 100 or something like that. So they really do start causing you to take out a lot. But once you're in your 70s and 80s and even in the early 90s, you can still have growth inside that account even though you're taking distributions from it.
I while you're talking about this, I just hate the way government does things sometimes. The way they do it is a distribution period in years. Why can't you just give me the percentage? Why can't it be like 50%? Instead, it's like at age 100, distribution period in years, it's 6.3. It's like, why don't you just give me like 50% or something?
Percentage, yeah.
But this does go up to 115 and older. So it does kind of expand over time, which, I guess kind of protects people.
So it goes to 115 now.
Yeah.
It used to be age 100, so now it's 115.
Yeah. So it does go on there.
And Harrison, this is, and Chase is right. There is kind of mystique here. Like, well, what's really going on behind the scenes? Maybe next week you can kind of share that with us. And could there be a point that you do get, like, again, my client's 93. Is there a point that you should take out more? Because, again, if you get to a point where, okay, well, now you got to take out 25% of the account, that could be a big tax problem.
Absolutely. And that's where the planning comes in place because, generally, as we go through our lives, there's different tax phases that we go through depending on what your income sources are. And sometimes, even when you're taking RMDs, it makes sense to take out a little bit more because we know in the future we're going to be taking out a higher amount. So that's, where the understanding comes in and the planning comes in.
Right. All right. Well, thanks for joining us this morning, and we'll see you Monday morning, and we'll talk to you more next week right here on the Smart Investing Show.
All right. Thanks, guys. We'll talk to you. I'll see you on Monday.
All right, Harrison. Have a good one. Bye-bye. All right, again, that's Harrison Johnson, our financial planner. If you do want to sit down for a free consultation with him, you can do that. Do it one or two ways. Call the office, 858-546-4306. That's 858-546-4306. Or go to our website, smartinvesting2000.com. That's smartinvesting2000.com. And I guess you can see more about us there. You can actually email Harrison there as well. But again, it's a free consultation. And again, I think you'll be very impressed on what he has and compare him to your current financial planner. If you don't have one, I think you might want to look into getting one. So again, that's Harrison Johnson, 858-546-4306. All right, let's go back to the calls here. The phone number's here. You're not joining the show. We got a few minutes left here. 866-577-2473. That's 866-577-2473. Let's go out to San Diego and speak with Douglas. Douglas, you're on the Smart Invest Show. Brent Chase, how can we help you? Good morning.
Good morning. I'm out for a walk. I love listening to you guys when I'm out walking Saturday morning. Anyway, I had FedEx, and I sold it after the last earnings report, and I replaced it with Union Pacific.
Okay.
UNP. How do you feel about Union Pacific?
I'm glad you called about this one because I've made a lot of money over the years on a Union Pacific Railroad. I'm not held up for a while, so I'm always kind of curious how it's doing. So I'm glad you called in about it. Let's take a look at Union Pacific Railroads. Not much on the short side there, 1.2%. The institutional ownership is 79.7%. PE ratio. Well, I got to ask you, Douglas, what's all that background noise there?
It's a radio.
Oh, okay. Can we turn that down a little bit? It's a little bit. Okay.
How's that?
That's much better. Much better. Okay. The PE ratio.
I'm out walking. I had the radio clipped to my sweater.
Okay. So the PE, no problem. PE ratio for Union Pacific, 27. That's very high, but the industry's even higher at 40.4. Price to sales, 7.7 versus 2.9. Price to tangible book value, 10.8. That is better than the industry at 15.3. Price to cash flow, 19 versus 19.6. And the PEG ratio for Union Pacific, pretty good, 1.5. I say that because the industry's at 15.7. Now, we do see that the earnings per share growth over 1 year, 11.8%. That's well above the industry at 0.7. 5-year earnings per share growth for Union Pacific, 12% versus a negative 3.5 for the industry. Now, the sales growth is up 4.9% for Union Pacific Railroad versus a negative 25.3. 5-year growth on the sales not quite as good, only 0.6, but the industry fell by 5.1. Now, the 5-year growth on the earnings per share is 15.6% versus 7.3. They do pay a dividend, 1.8%. They use 45.2% of their earnings to pay that out. We do take a look at the balance sheet here. Current ratio 0.9 versus 1.3. Debt to equity, this is not good. 210% versus 120% for the industry. So I would want to find out why is their debt so heavy. That does not make me feel comfortable. Net profit margin is very good, though, 28.6 versus 4.8. Return equity, very attractive for Union Pacific, 41.1 versus 11. Chase, what do you got going forward?
There's a current price here for Union Pacific. Well, that's $237.59. 52-week high. Well, currently, it looks like the numbers haven't been updated yet, as it's actually below that, so it's not quite what we want to see there. But the 52-week low is $171.50. Next thing we're looking at is going forward for Union Pacific. I see in 2022 the company's estimated to make $11.34. Unfortunately, that would give us a target sell price here using our 16.6 multiple for Union Pacific. Let's see, that would give us a target sell price of just $188.24. So it is a little bit pricey here, Douglas, and I think it is a benefactor here as we know people are buying a ton of goods. We again know there's demand. We talked about the ships off the ports there, but I don't feel comfortable with that valuation, to be honest with you.
Yep.
Okay.
Yeah, I would have to. I would not want to hold it any longer by these levels. All right, Douglas.
Really? Okay. All right. Thank you.
You're welcome. Thanks for calling. Bye bye. Chase, it is funny. I don't know how long ago it was I sold Union Pacific. I want to say it was at least 4 or 5 years ago.
Oh no, longer than that.
Longer than that.
I mean, you're probably talking. Gosh, because I've been with you now for over 6 years.
Okay,
so you're probably talking 7, 8.
Did you by chance have a graph of it? Because I think I sold it. I want to say around 150 or so. And I know we bought it at a very good level. I can't give too much detail because of the advertising rules, but I'm pretty sure I sold around 150. And if it's not split, I mean, that's not much of a gain over that time frame.
I think they must have split because back in 2015, it looks like it hit 123.
Right.
Was kind of the price. And I'm guessing it was around that time frame because I started with you full time in 2015, and that was kind of the peak. So I'm guessing you probably sold it back then. It's actually not done that bad since then.
And it's just one of these companies that I like. I mean, I just wish it wasn't so pricey because it's one of these companies that is doesn't have a lot of expenses to it. I mean, and I think they get like 200 miles to the gallon or some crazy thing
Wow.
on the trains. It's just a good business to have. There's not much fanciness with it. You got to have it. You got to have the trains to get the goods across country and so forth. But I'm just disappointed that's kind of pricey at this point in time. But it's one that I would like to buy again at a lower price if it went on sale.
Yeah.
So.
Yeah, absolutely.
Yep. I do want to talk about real quick. I know we only got a few minutes left here, but the workforce, based on a recent survey of offices in 10 major U.S. cities, the percentage of the workforce back in the office is now about 36%, and that's compared with 31% the week of Labor Day.
Yeah, I mean, it's still well below the 50% mark, but I think we could surpass that easily by January 2022. I think that we will see more and more people come back to the workforce. Not the workforce. I think we will see, people come back to the workforce, number one, but also come back to the office as well. I don't know. The remote, it works for some people. I think for a majority of people, I don't know how effective it is. So we'll have to see.
And actually, in our office, we had a larger company come back, and I talked to a couple of the women that are there, and they go, "Oh, it's so nice to be back. I like seeing people and doing stuff." So
it creates more of the camaraderie.
Yeah. Makes it just feel good and stuff. So I do got to mention Mel in San Diego and Bill in San Diego. I'm sorry that we are out of time. Please call back in next week. We'll answer your questions. I can't tell what the symbols are. The company's based on that, but please call in next week. We will get to you.
Yeah, I did want to say one thing. As many people know, I coach football at Poway High. Unfortunately, our running back, his name's Connor Rath, suddenly lost his dad last week.
Mm-hmm.
Just out of the blue, had no idea that it was going to happen. The family's kind of really struggling, so some of the kids did set up a GoFundMe for the family. They're kind of having some hard times, obviously, getting through this. So I wanted to point that out just for the family. If you go on GoFundMe, you just Google Connor Rath. The last name is R-A-T-H, and it's a tribute to Scott Rath is the name of the GoFundMe page. So, great kid, hard worker. Obviously terrible to lose your dad at that age.
And the dad was what, like in his 50s or something?
In his 50s, yeah.
Young boy, and I think he does well at football and stuff.
Oh, he's a star running back. Great kid, too.
Yeah. It's such a shame when that happens. And, and this is why, and again, not to play off of that, but this is why you need financial planning, because you need to know what you need, and you never know what's going to happen. To be in your 50s and have a heart attack and die is just it's terrible. So we'll see what we can do to help them out as well.
Yeah, so I just want to throw that out there. Again, last name is Rath, R-A-T-H. Connor's the first name. Dad's name's Scott. So any help for that family would be very helpful.
Yeah. All right, well, there's a closing bell. Thank you for listening to the Smart Investing Show. It is for informational purposes only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs, have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-546-4306. That's 858-546-4306. Or visit our website, smartinvesting2000.com. That's smartinvesting2000.com. And for more daily educational information tips, along with investment tips, go to our Facebook group page, Smart Investing with Brent Chase Wilsey. Thanks for listening to the Smart Investing Show. We'll be back next week. Have a great weekend, and we'll talk with you soon.
To think that I did all that, and may I say